Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors, December 23rd, about an hour before the close. Trying to spread a little holiday cheer. We're in the lobby of our building today. Beautiful Christmas tree behind us. Keep in mind, the bond market closed at 2 p.m. today. I'm hoping the equity market just drifts into the close, doesn't give us any headaches. So what are we looking at? We spoke last week. Where did we add into Thursday, Friday of last week? We added to energy. We added to value. Value held in well this week. Energy, nice week. Nice push off that add last week. What has been working continues to work. What hasn't been working still can't get out of its own way. Perhaps we got a peak in growth being over-owned a year ago, and it's still taking time to push that capital out of the growth names. We'll get there. There'll be a time to buy growth, the traditional NASDAQ names. We'll just keep our eye on supply and demand. Speaking of keeping our eye on things, over the last month, I've shared with you a momentum chart. I want to bring up today's snapshot of where we are in weekly momentum. If you look at the red circle at the top of that chart, that's when we started highlighting the fact about a month ago that we were getting overbought. We were getting to an area that we didn't want to allocate more capital to the market. In fact, might make sense in that range to sell a little bit. Now, as we've let that momentum wane and start to turn down into an area that becomes attractive, you see where we are. We're down there. We're only 24% of companies on the New York Stock Exchange are trading with positive momentum. While that may not sound like a positive, what it does eventually is get us into an area where most of the negative selling or the supply gets wrung out. And that's that green circle I've identified for you. That's where we're going to get more aggressive with our capital. Keep in mind, throughout our strategies, we've been fairly defensive. We have a good slug of cash throughout our strategies. We'll let this momentum continue to drift south, and when it turns up, we'll feel that there's a reasonable risk reward to add and get aggressive. We don't know, is that early January, mid-January, or is it next week? We don't know, we'll find out, but we'll let the market dictate where the risk is. It's been a great 3-year ride doing our Friday videos, and I'm glad so many of you get something out of them. All we started with was trying to be transparent with our clients in what we were buying, selling, and thinking. And now we've met a host of new friends throughout our 3-year journey. So let's take a moment, toss it over to John Mousseau, who's going to cover fixed income for us.
Hi, it's John Mousseau. I'm the president and CEO of Cumberland Advisors. It is Friday morning on December 23rd. This week in bonds, we saw yields up across the board. Think about this morning with the 2-year at around a 430, the 5-year bond around a 385, and the 10-year bond around a 372. 2-year up about 12 ticks this week, the 5 and 10 about up 22 ticks, 30-year bond at a 377 also up 22 ticks. What happened this week? Why did yields move up? It certainly wasn't the data. We saw, the PCE, the Fed's preferred measure of inflation, be very well behaved this morning. Durable goods actually down a bit. So the data is bond friendly. What happened this week was we saw an announcement from the Japanese central bank. They are going to start to basically get more hawkish, start to raise rates. And what we saw was a reaction in the Japanese bond markets. So we have a graph up here of the Japanese 10-year bond. And whereas the nominal rate isn't that high, the jump from basically a quarter of 1% all the way up to almost half of 1% before settling down a bit. Percentage-wise, that's a huge move. And that sent the ripple effects basically through the rest of the bond markets around the world, including here. We're going to be watching this. Again, we think what's important here is the interplay between the Fed, which has not change their tune at all. They're going to continue to raise short-term rates. At what pace we will see, we believe smaller pace for sure. But they are serious about making sure that inflation continues to come down. And, you know, the markets clearly think that the Fed will pivot sooner towards either cutting rates or just pausing, if you will, than the Fed is making noise about. And you can tell that by the continued negative yield curve between 2-year and 10-year paper, which has moved around a little bit. But we've said this before, it's important to realize that just back at the beginning of November, that 2-year Treasury bond was at a 470. So it is, even though it's up a little bit this week, it's down significantly in less than 2 months. So the markets think that the Fed has, if not broken something, has done enough to slow the economy, even though the Fed is saying otherwise. Muni bond yields this week up 7 or 8 basis points. Mainly that was a reflection just of scales being cut a little bit and really no supply. And this is typical of the muni market. You won't see any supply until you really get to the first of the year when the bankers start coming back. And even then, the first week is usually slow. So we'll be back next week with kind of a recap of the bond year in general as we say goodbye to 2022 and say hello to 2023. So we hope everybody has a very Merry Christmas and is having a nice, happy Hanukkah, and we'll see you next week. Thanks a lot.
As John mentioned, we wish you happy holidays and a healthy new year. Don't forget to like, comment, and subscribe so you can follow along with our videos. And we'll see you next week on the doorstep of 2023.